What is an activity ratio and how can it help your business to grow? In this episode, you will learn the meaning of activity ratio and its importance. Let's dig in. An activity ratio is a sort of financial metric that shows how efficiently a company is taking advantage of the assets on its balance sheet to generate revenues and cash. Activity ratios are most valuable when utilized to compare two competing businesses within the same industry. This comparison is done to determine how a certain corporation stacks up amongst its peers. Activity ratios may also be utilized to monitor a company's fiscal advancement over multiple recording periods. This is done to detect changes over time. What is the importance of the activity ratio? Activity ratio offers the following benefits to a business. An activity ratio focuses on describing all financial metric that enables investors and research analysts to gauge the efficiency of a company using its assets to generate revenues and cash. Activity ratios may be employed to compare two separate companies within the same industry. Activity ratios can be subdivided into the following categories: merchandise inventory turnover ratios, total assets turnover ratios, return on equity measurements, and a spectrum of other metrics. Classification of activity ratios. Activity ratios are categorized into three bases, and they include the following. 1. Total assets. Total asset turnover is a measure of company efficiency by utilizing its total assets. A high ratio suggests that a company does not own numerous assets. A low ratio suggests that too much capital is tied up in assets and that assets are not being used properly in generating revenue. Total assets also refer to all the assets that are reported on a company's balance sheet, both operating and non-operating. 2. Working capital. Working capital is the surplus of current assets over current liabilities. The level of working capital provides an insight into a company's ability to meet current liabilities as they come due. Achieving a positive working capital is important, but working capital should not be too enormous to tie up capital that can be used elsewhere. Working capital can be clearly described in three parts, and they include receivables, payables, and inventory. 3. Fixed assets. Fixed assets are tangible long-term assets that are non-operating. This implies that they are not employed in the daily activities of a business. They are also referred to as non-current assets. Fixed assets best describe the tangible assets that are expected to provide an economic benefit in the future. Some of these economic benefits include property, plant, and equipment, PPE, furniture, machinery, vehicles, buildings, and land. Thank you for staying put to the end. We hope that you have learned something about the activity ratio. See you in the next episode.